Hi, we thought we'd give you a quick update on some of the issues that are lingering out there for the stock and bond market. So Janet Yellen came out and said the government officially runs out of money on June 1st. That's not good. We keep having to go through this exercise. It seems like every year, every other year. It seems ridiculous to have happen to our country. But this time we kind of think it might be a good thing to put some discipline into spending as government spending is out of control. This might turn out to be a positive event rather than a negative event. We have to get through it first, right? It'll probably come down to the very last minute. And when this occurred in 2011, the stock market fell roughly 19% as they worked their way through a compromise. So expect it to come down to the last minute. Neither side wants to compromise, so it should be a fun 30 days. The Federal Reserve raised rates last week to 5.25 on the upper end of the range. We think they're done. Now we see what the impact is. They raised rate at a record pace, so we don't know for sure what the impact of the economy is. It probably won't know for at least 6 to 12 months as rates start to adjust on all the borrowing that's out there. The S&P 500 is up roughly 7.7% year to date, anticipating that the Fed is pausing. So we think a lot of this has been discounted in the stock market already, that the fact that the Federal Reserve has paused and we're in this flat period, stage 3, this is where the market flattens out. So we're in this flat period of everything's still okay, nothing's breaking yet, and to follow by something breaking in the overall economy, and we hit a stage 4 later on, probably late this year or early next year, the economy will be in a recession. So right now we're in a flat period. There's no way we're going to break to a new high. So we're in a trading pattern, or a trading range, sorry. We're in a trading range between 4,200 and 3,800. 4,200 on the upside. We tried numerous times to break through there. It could break through there. Maybe it goes another 5%, but there's nothing to hold it there. So we think that it eventually drifts back down to the lower end of the trading range around 3,800. Right now, though, there's twice as many bears as there are bulls, so we don't think that there is a major decline that'll occur real soon in the stock market. That's going to be pushed out to later in the year. Inflation will be reported on Wednesday and Thursday, with PPI on Thursday and CPI on Wednesday. The major component to the inflation has been oil prices. So oil prices have had this monster move down. So this is one of the reasons why inflation has been high, is because oil prices got so inflated. It pushed goods prices up. People had to spend more on transportation as well. Everybody wanted to pay increase because of the higher goods prices. Now things are moderating. Good prices are starting to roll over a little bit. So we're not concerned about inflation at this point in time. The 10-year Treasury, this, in my opinion, besides the debt ceiling, is the most important thing to the stock market at this point in time. This is what we see. We see that it really can't penetrate any lower to the downside. We see that it's kind of stuck in this 3.5 to 3.4% range. The trend of the 10-year Treasury is up. You see the 200-day here. It's in a nice upward trend. It's consolidated. Kind of think it's going to go to the upside, even with the slower economic growth that we're envisioning. I think it just got too overshot to the downside with the banking crisis and the inverted yield curve, and everybody already anticipating we're going to go into recession. So yields could go up at the 3.75 level to 4%. We think that's a problem for the overall stock market. The PEs on 2023 for the stock market currently 18.7 times. We know the earnings are coming down, so this PE is more like 19.5 times. We don't think that the stock market can support a 20 PE multiple. It's just not possible. So rates would have to be 3% or lower to get much above 20 times earnings. So there's no valuation catalyst for the overall stock market, particularly if rates start to go upward from here. The banking crisis, we think it's kind of moderating at this point, but there might be more to come. We think the really bad banks have probably failed. But what's happening is that in general, the regional banks bringing money inward, so they're being more conservative, they're restricting credit. Also, what happens when the yield curve inverts, all banks start to restrict credit. So just a natural thing that happens in the banking industry when the short rate is much higher than the long rate. There's no desire to really lend money long when you're having to borrow at a high rate on the short end. Money supply. So the banks restricting credit is one reason. The Federal Reserve cutting their balance sheet is another reason. So money supply has actually fallen roughly 4% over the last 12 months. That is a lot. You can see the magnitude of that decline. However, keep in mind that money supply went up 42% during COVID as all the money printing occurred. So the economy has gotten used to this high money supply. Even bringing it down 4% is becoming an issue. We think that this will continue to worsen and will be a problem for the financial markets. Final thoughts. Okay, so the market's in a sideways moving pattern, probably stuck there until at least the debt ceiling is passed. We get some resolution around that. We get more clarity on 2023 earnings and 2024 earnings. We think that 2024 earnings are going to come down a meaningful amount, and then 2025 earnings will look like what 2024 earnings are currently expected to be. So we're going to lose a year of earnings, which usually means we're going to be down about 8 to 10% on the stock market when that occurs. We're in a sideways moving pattern. The technicals are slightly positive for the stock market. They're turning negative in terms of bond yields going up, so we'll have to watch that very closely. The most important part here is to keep an eye, besides the debt ceiling, but to keep an eye on the 10-year Treasury. The 10-year Treasury starts to move upward, starts to get in line more with the Federal Reserve policy. You know, remember, Fed funds rate 5.25, 10-year Treasury 3.5. That is a historically very wide spread. Usually there's some more correlation between the two. So we think that naturally the 10-year Treasury could rise, causing a valuation problem for the overall stock market. So thank you. Please hit like. If you want a hard copy of Market in a Minute, a research piece that we sent out free of charge, website, Patrick Adams CFA, and sign up for it, and we'll send it to you on a weekly basis. Thank you.